All right, today we're breaking down a really eventful quarter for Fifth Third Bank. You've got two massive and kind of conflicting stories here: a truly game changing merger on one side and a pretty messy fraud incident on the other. So let's get right into it.
So, this is really the whole story in a nutshell, isn't it? On the one hand, you have this huge landmark deal to merge with Comerica that could change the whole company. And then, bam, on the other hand, you get a nearly $200 million fraud issue that completely spooks the market and gets everyone asking tough questions about credit quality. So, which one is it? Which story is the real story for Fifth Third right now? Okay, before we dive into all that drama, let's do what we always do and start with the hard numbers. Let's see what the quarter actually looked like on paper. First up, 93 cents. That's the adjusted earnings per share. And what's pretty amazing here is that this is after they took that huge provision for the fraud incident. That just goes to show you the underlying earnings power of this business is seriously strong. And this right here, this is the number that really tells you about the core profitability. PPNR, that's pre-provision net revenue, was up a whopping 11% from last year. Now think of PPNR as the bank's profit before setting aside money for any potential bad loans. And that number isn't just growing, it's accelerating. This is exactly what you want to see. It means the core engine is firing on all cylinders, even with all the other noise. And check out the top line, $2.3 billion in adjusted revenue. That's the highest level they've hit since 2022. And the best part? This wasn't just a one-off thing. It was driven by solid growth in both net interest income and in fees. That's the kind of balanced performance that shows real health. So let's just zoom out for a second with this snapshot. You can see the story right here, plain as day. Look at all that growth. Revenue up 6%, loans up 6%, and tangible book value per share, which is a really key measure of what a bank is intrinsically worth, is up a very strong 7%. The takeaway is loud and clear. If you strip away the headlines, the fundamental business is doing really, really well. Okay, so we've established that the numbers are solid. Now let's get into the real meat of the quarter, the two huge stories everyone was talking about, the merger and the mess. First, let's talk about the merger. Management was pounding the table on this one. They made it super clear that this isn't just about getting bigger for the sake of it. Nope, this is a surgical, strategic move. They're taking their fantastic retail deposit gathering machine and plugging it directly into Comerica's crown jewel middle market business. And what's more, it gives them a massive footprint in some of America's absolute fastest growing cities. It's a really smart play. And then there's the mess, the fly in the ointment. This one single fraud incident at a client called Tricolor forced this massive provision, and it just sent a shockwave of concern right through the market. All of a sudden, everyone was putting a very specific and maybe a little misunderstood part of their loan book under a microscope. And that part of the loan book is called NDFI. It stands for non-depository financial institution. And honestly, this term has become kind of a boogeyman for bank investors lately. Why? Well, it's this big, kind of opaque category that can hide all sorts of different risks. We're talking about lending to other financial players that aren't traditional banks. Think REITs, private credit funds, that kind of thing. Now, this slide is absolutely crucial because this is how Fifth Third fought back against that narrative. They broke down their entire NDFI book for everyone to see. And look at this, the problematic category, this consumer asset warehouses where Tricolor lived. It's the tiniest slice of the pie at just 9%. The vast majority of this portfolio is in things they consider much lower risk, like REITs and payment processors. And management drove this point home hard. They came out on the call and said, look, in our biggest NDFI segment, the REITs, we haven't had a single loss in over a decade. Now, that's a powerful piece of context, right? It really helps to frame that Tricolor mess as an isolated incident, not some kind of systemic problem across the whole portfolio. So, moving beyond the merger and the mess, let's look at the bank's organic growth engine, because this is where their underlying strategy is really starting to pay some serious dividends. I love this chart. It tells such a clear story. The broader market in the Southeast is growing at a pretty healthy 1.7%. But look at Fifth Third. They're growing their customer households there by 7%. That's more than 4 times the market rate. It's just undeniable proof that their strategy of opening new branches in these high-growth areas is working like a charm. And the growth isn't just in retail banking. The momentum here is impressive all around. Their middle market business, new client acquisition is up a staggering 40% year over year. Their new line payments platform, which is their fintech play, saw revenue jump 31%.
And their wealth management business is scaling beautifully, with fees up 11%. This is the kind of broad-based, high-quality growth investors love to see. So, what does all this mean for the future? Well, let's take a look at management's official guidance for the fourth quarter. What's their playbook? So the guidance here really tells a story of stabilization and continued momentum. They expect net interest income to hold up, even with potential rate cuts. They see fees continuing to grow, and they're keeping expenses under control. But the most important line item here is net charge-offs. They're guiding to a return to a normalized 40 basis points. That's their way of signaling to the market that they believe the tricolor issue is officially in the rearview mirror. Oh, and one last note on capital. Share buybacks are on pause for now. This is completely standard procedure. You don't go out and spend billions to buy a competitor while you're also buying back your own stock. They're just conserving capital to get the deal done. You can expect the buyback machine to turn back on after the merger closes. All right, so let's put it all together. You've got solid core numbers, a transformative merger, a one-time credit scare, and some pretty steady guidance. So what's our take? What's the verdict for the next call? We are rating Fifth Third in outperform. We think the market is just plain mispricing the opportunity here.
And here's our thesis. It's pretty simple, really. Just 3 parts. First, we think the credit fears are way overblown. Management did a great job showing that Tricolor looks like a one-off. Second, the organic growth engine in the Southeast and in payments is real, it's powerful, and we think it's being overlooked. And third, the co-market deal is a genuine game changer that creates a more profitable, higher growth bank for the future.
So how do you play it? The trade idea is to go long Fifth Third common stock. Right now, the market has fixated on the credit scare, but it is completely underappreciating the strength of the core business and the massive earnings power of the combined company once the Comerica deal closes. As we see credit normalize in the fourth quarter and they start hitting those merger milestones, we see a clear path for this stock to re-rate significantly higher. It's really a compelling story of a great company being temporarily overshadowed by a single negative event, and we believe that creates a clear opportunity. Of course, as always, this is not financial advice.